When assets, investments, or family structures become more international, a normal operating company may not be fit for the job. You may need a clean, separate vehicle to hold shares, assets, or sit below a foundation or a trust, or support a specific transaction. Using a full operating company for that purpose can create unnecessary cost and administration. Holding every asset personally can also create probate delays, unclear control, and succession problems across jurisdictions. This is where a DIFC prescribed company becomes relevant. It is a focused company used for defined structuring purposes inside a recognized financial center. My name is Shiraz Wahid and I'm the co-founder at Lepidus Wealth. And in this video, I'm going to explain what a DIFC prescribed company is, how it works, where it fits in asset holding, and what you need to consider before setting one up. In general terms, a prescribed company is an SPV or special purpose vehicle. It is usually not used for running a trading business. It is used when there is a specific ownership, holding, financing, or structuring purpose that needs a formal legal vehicle. A DIFC prescribed company is a private company established under the Dubai International Financial Center framework. It is commonly used as an SPV or special purpose vehicle, which means it exists for a defined role rather than general commercial activity. It may hold shares in other company, hold specific assets, sit inside a family wealth structure, or support an investment or financing agreement. Its role is usually limited and connected to a wider structure. This makes it different from a normal operating company. A normal company may employ staff, deal with clients, generate revenue, and run day-to-day business activities. A prescribed company is usually a holding or structural vehicle. The structure is designed to be efficient, but it still sits within DIFC. It remains part of a recognized legal and regulatory environment and not a loose offshore arrangement where no clear governance exists. Many investors need companies that do not trade but still perform an important legal function. They may need to hold assets, separate ownership layers, support succession planning, or create a corporate link between jurisdictions. Without this type of vehicle, families often use several offshore companies in different places. That can work, but it may raise questions around governance, banking, tax treatment, and long-term control. DIFC offers an alternative inside a financial center with its own legal system, codes, and governance framework. A prescribed company can also work with other DIFC or UAE structures. For example, a DIFC foundation may sit at the top while a prescribed company sits below it to hold specific assets or investments. Now, when it comes to use cases, the first common use is asset holding. A prescribed company may hold shares, investment interest, or assets that should not be held directly in an individual's personal name. When assets are personally owned, they usually remain connected to your estate. If succession is triggered, probate may be required before control can move, especially when assets are spread across countries. The second use of a prescribed company is to ring-fence assets. If different assets carry different risks, you may not want them all held in one entity. A prescribed company can help isolate a specific asset, project, or investment from the rest of the structure. The third use is succession planning. The company can continue beyond the life of an individual. If it is owned by a foundation or a trust, control can pass through the governance documents instead of relying only on personal estate process. The fourth use case is transaction structuring. Investors may use a prescribed company to hold an investment, enter into financing, or create a clear ownership layer for a defined commercial purpose. The structure should match the purpose. A prescribed company is useful when there is a legitimate reason for a focused entity. It should not be treated as a shortcut for every type of business activity. A DIFC prescribed company is not available in the same way as a standard free zone company. The applicant must usually fit within the qualifying requirements under the DIFC regime. In practice, the company must be connected to a qualifying applicant or established for a qualifying purpose. This matters because the eligibility route affects what the company is allowed to do and how the application is reviewed. A qualifying applicant may include certain DIFC connected structures, family businesses, government entities, or other applicants within the permitted categories. A qualifying purpose may include approved holding, financing, or structuring functions. Before setting up the company, the purpose needs to be clear. Is the purpose to hold shares, sit below a foundation, or it is being used for investment or financing? The answer affects the application, documents, and permitted scope. Once approved, the company should remain aligned with the purpose. If it was created for a narrow holding role, it should not later be used as an operating business without checking whether that activity is allowed. For many international families, the prescribed company works best as one layer within a wider structure. A DIFC or ADGM foundation may sit at the top. The foundation provides governance, succession layer, and control rules. Below the foundation, one or more prescribed companies can hold specific investments, company shares, or assets. This creates separation between ownership, control, and benefits. The asset is not held personally. The risk is not placed directly inside the foundation. The prescribed company becomes the holding layer, while the foundation remains the governance layer. A trust can also hold the shares of a prescribed company. In that case, the trustee controls the company's shares while the company holds the underlying assets. This can help with administration, banking, asset separation, and continuity. The type of structure can support multi-jurisdictional planning. The company may be valid in DIFC, but tax treatment can depend on residency, domicile, source of income, and the rules of the country where the family members lives. A prescribed company may look simple, but it still needs proper governance. Directors, shareholders, beneficial ownership, and company records must be maintained correctly. Banks will usually want to understand why the company exists, who controls it, where the money comes from, and what assets it holds. A clean structure is easier to explain than a chain of companies with no clear reason. A prescribed company should be created as part of proper planning, not as a reaction after a claim or a dispute on an investment or a property already has appeared. If assets are transferred after a legal risk has become clear, the transfer may be challenged depending on the law that applies. The main advantage is efficiency. It can provide a legal holding vehicle without needing the same operational footprint as a normal trading company. It can also improve succession planning, reporting, and future transactions. But there are limits. A prescribed company should not be used for unrestricted trading activity. It is also not a substitute for a regulated financial services license. If the activity involves investment management, advisory services, fund management, or other regulated services, separate DFSA approved licenses may be required. It also does not remove tax considerations. The tax position depends on the full structure, the country of tax residence, asset type, and reporting obligations. A DIFC entity can be useful, but it is not a standalone tax solution. The same applies to inheritance planning. A prescribed company may help with continuity, but the shares of the company must be owned correctly. If you personally own the shares of the prescribed company, succession may still be connected to your personal estate. The setup process starts with the purpose. Before documents are prepared, you need to define why the company is being created and how it fits into the wider structure. The next step is eligibility. The application must show the correct qualifying route, whether that is based on the applicant, the ownership structure, or specific purpose of the company. After that, the structure needs to be mapped. Who will own the shares? Who will act as the director? Will the company sit below a foundation, trust, or a family holding company? And what assets it will hold? Once the structure is clear, incorporation documents can be prepared and submitted through the relevant DIFC process. After incorporation, the company must be maintained through renewals, filings, records, and beneficial ownership updates. A DIFC prescribed company may be suitable where you need a focused holding vehicle inside a recognized jurisdiction. It can be useful for shares, regional assets, succession structures, or investments in specific transaction planning. It may be less suitable where you need a full operating business, employees and trading activities, or regulated financial services activities. In those cases, a different DIFC entity, mainland structure, an ADGM company, or a regulated financial license may be more appropriate. Ultimately, the decision depends on the purpose, banking requirements, and the succession requirements. Now, if you are considering setting up a DIFC prescribed company, the important step is to make sure that your prescribed company sits correctly within your wider ownership structure. And if you want our help reviewing whether this structure fits your situation, you can request a personalized asset protection plan by clicking the link in the description below. That's it for today, and I will see you in the next video.